monetary policy. So what is involved in monetary policy? So economic policies and management, we're looking at purpose of monetary policy, the implementation of monetary policy by the Reserve Bank of Australia. So what's involved, so the cash rate, interest rate, that's all things that you would want to be aware of, as well as what's the definition of monetary policy, how does it work, what's involved. Impact of changes in the interest rates on economic activity and the exchange rate. So because you're changing the interest rate, it doesn't just impact, one thing, it impacts many things. It has many flow-on effects, which is really important to understand and analyze. So it's going to impact economic activity. It's going to impact spending. It's going to impact consumers. It's going to impact a wide range of different things that need to be considered, as well as it's going to impact the exchange rate. And the exchange rate is very, very important to make sure that it's at an appropriate level compared to other economies, because that's going to impact investment, spending both into your country and outside your country. And the current monetary policy stance. So where is the current monetary policy stance at? Where is it sitting? What does it mean? How do we approach it? Etc. Okay. So what is monetary policy? Well, it involves the setting of interest rates administered by the RBA on behalf of the government. Okay, so it's very important to take that into consideration. So on behalf of the government. RBA is sort of a separate entity to the government, but they are doing it on behalf of the government. They're setting the interest rates. Okay, and the way that they do this is through the cash rate. And you may already have learnt about domestic market operations, DMOs. If you have not, you will learn it. I'm sure you will learn it as a part of your course as well. So the aim is to smooth the effects of economic fluctuations and maintain low inflation. Alright, so we want to try and smooth out these fluctuations of these ups and downs that happen so often. We want to try and smooth those out and try and keep it as stable as possible. And the main sort of idea is to lower inflation, because remember we went through the impacts of high inflation. There's a whole list. Okay, so we want to try and avoid that. Okay, so price stability, full employment, and economic growth. So RBA's inflation target framework aims to keep inflation between 2% and 3%, like we talked about. So they have a goal, they have a target of achieving basically ensuring that their inflation stays between 2 to 3%. Anything higher or anything lower is detrimental. If inflation or the CAD rises, the RBA may tighten monetary policy to reduce spending, as this may threaten the stability of growth. What does this mean? It means that if inflation rises, which means that the price of goods and services rises, it's going up too high, people are spending too much, they're going to just tighten up and reduce spending. So they're going to increase the rates so that it becomes harder for people to borrow, and people will start saving their money. They won't borrow as much, and it's going to push inflation back down. Because think about the types of inflation we went through, right? We went through demand pull inflation, cost push inflation, imported inflation, inflationary expectations. A lot of these require individuals to go out and spend. High levels of consumer spending. Consumer spending here as well. Inflationary expectations, imported inflation, all consumer spending. So in 2010, the monetary policy returned to more of a neutral position as the GFC impacts eased, with the cash rate rising to 4.75%. Right, so in 2010, sort of went back to normal because we had the GFCs like during around 2008 to 9. So that's when it sort of started going back to normal. So why was this? It was because there was a domestic economic recovery and strong mining sector growth, which saw the RBA refocus on containing inflationary expectations. So they really wanted to try and focus on containing all of this inflationary expectation, which if we go back to inflationary expectations, you can see here what it involves. So this idea that consumers expect prices to rise, so they increase spending. things like that. They want to try and control that because we just had the GFC. That's probably how consumers are feeling. So a lot of economics is also to try and understand and to analyze consumer habits, whether that be spending habits, whether that be, what trends are involved in terms of their savings versus spending and their household savings, etc. That's why if we go right back to the start of the lecture, here, it's so important, right? You may be thinking, why does this even matter? Why does the household saving ratio matter? This is why. Right? Because we want to analyze how they're spending, how they're saving, how much they're saving versus how much they're spending. That's why we even went through the multiplier. We went through marginal propensity to consume. So the proportion of every extra dollar that they consume versus how much of it they save. Right? These are important concepts. It may not seem as important or relevant when you're first going through it, but you can see how it all ties up together. And tying it up together can actually help you understand the concept better and understand the topic better than if you were to just go into it without understanding what different concepts are. Okay? So let's go back to the monetary policy. Yeah. Yeah. Conversely, monetary policy may be eased if growth is below the target and unemployment is rising. Okay? So that's again important to consider this idea that if growth is below the target, unemployment is rising, they're going to try and ease up the monetary policy, the cash rate, DMOs, interest rates, and try to control it less than they would be when they're tightening it. So let's have a look at some of these ideas here. So the current stance of MP on monetary policy. So currently, the RBA is hiking the cash rates back up from its initial drop during COVID-19. So during COVID-19, there were a lot of decreases in the rate, and there were a lot of issues surrounding that. So they had to sort of address those issues. So, like, they had essentially just decreased the rate quite a bit to try and increase spending, because the aftermath of COVID, a lot of people were just saving all of their money. They weren't going out to spend, etc., etc. So what the government did was they actually said, okay, let's go back and let's try and increase the rate back up because now it's sort of going back to normal and we're trying to move away from the impacts of COVID. So as at 6th of June, it is the 12th increase in the rate, and that has created financial stress that will hurt households and businesses, according to The Guardian. This idea that when we increase the rate, we have to think about the fact that a lot of people have mortgages that are on a variable interest rate, and paying that back can be very difficult if there is rate increases. We also have to consider that a lot of people have spending and they need to spend for their businesses, things like that. They need necessities, and when the rate keeps going up, it means that it becomes more difficult to attain those things. So there has actually been so much financial stress, and the RBA and the governor, Philip Lau, has faced a lot of criticism for their constant and consecutive increases in the rate. I think the last one that they had, they kept it the same, which was in June, I think. Don't quote me on that. The hike to 4.1% is the highest in 11 years. So it's not expected, and the economy is not really used to having such major increases in the rate consecutively, like in a row. So that is something that you can definitely mention in an essay, and take into consideration when you're talking about it, because it is so important to make sure you're referring to these things. You will be expected to mention some of these things in an essay because these are the contemporary economic understanding factors that we talked about. If I go right back to the start, bear with me a sec. over here. You need to know like the cash rate. You need to be able to understand all of these things. You need to be able to mention it in an essay, like I've talked about over here. Right? These are trends. You need to know these trends. You need to analyze the data. You need to talk about all of that in the exam. Because if you're not able to do that, then you're probably going to put yourself in a situation where you're not able to get the highest mark or full marks or reach your potential, really. So going back to where we were up to, bear with me a second. Yeah, so yeah, 4.1% is the highest that it's been in 11 years. So this is a quote that, for example, you can mention in your essay. So here are some quotes. So inflation in Australia has passed its peak, but at 7% it is still too high, and it will be some time yet before it is back in the target range. Some further tightening of the monetary, so this is from the RBA governor, by the way. Some further tightening of monetary policy may be required to ensure that the inflation rates return to target in a reasonable time frame, but that will depend on how the economy and inflation evolve. Remember, the target is 2 to 3%. It's sitting at 7%, which is why they're going through all of these hikes, which is understandable, I guess, in a way, but we also have to consider the financial stress on households, which is a lot of the criticism is coming from Australians saying that that is not being considered. The financial stress on households is not being considered when they are going through all these rate hikes, cash rate hikes. Okay, so what he said, if I highlight, they said that they want to try and get back into target range. Okay, so you can definitely mention that in the essay. Some further so when you talk about theory of what monetary policy involves, what's there, you want to talk about, and you're going to inevitably talk about the target range that they've had since the 1990s of, I believe the 1990s of like the target range, etc., of 2 to 3%, and how they were able to come to that. Then you talk about like the further tightening of monetary policy may be required, things like that. So they do want to try and get down to 2 to 3% because they're at 7%. So they want to do it in a reasonable time frame, but I think because they have been receiving a lot of the criticism, they have sort of slowed it down a little bit. So yeah, we'll see like how that continues on in the next few months, and I would definitely highly recommend you keep up with that and you have all of that information down, because in your exam it will become very, very handy for you. To mention that, right? So you want to be able to know what's involved, what's the current stance, because this is the current stance as at like June, the end of June, start of July. But like for you, it's like your trials and your HSC are towards like August, September, October. That's different. Like that's going to be very different to what it is right now, because there will be more changes in the stance, whether that be they remain the same, or they actually end up increasing more, or they decrease it, which is unlikely, but it's, again, don't quote me on that, like you'd never know what will happen. You do have like people who predict what will happen, but like an economist will like do a lot of analysis and say, okay, whether that the rates will increase, decrease, but you will get that information as well. I guess by the time trials and HSC comes, but you can also, I guess, in your essay talk about predictions after October, because your exam, I guess, will be in October. Around October time. So you can talk about what will happen after October as well, and that can show the marker your extensive knowledge and you've done that research, and that's going to be really important. And you can do the same for your trials as well. So yeah, it will depend on how the economy and inflation evolve, he said. So I've put down at the bottom a link to the article that I've quoted here, which is from The Guardian. It says that the RBA interest rates Reserve Bank increases cash rate by 25 basis points in attempt to quash inflation. So yeah, news articles like this are really important to what I was talking about earlier. If I go back, there's a lot of back and forth, but I guess I just really want you to all understand what I'm saying and why everything is sort of linked to each other. So this is why I say, have these like different articles that you can refer to, like different websites. Spend that 10 minutes a week and then make sure that you do make that connection between the theory and your news updates as like your quotes analysis. Okay. Cool. So, monetary policy is implemented by the RBA and it's done through the open or domestic market operation, which I was talking about earlier, which is also known as a DMOs. So, the cash rate is the interest rate paid on overnight loans in the short term money market. Right? So, this is basically the interest rate for the banks. Okay? So cash rate is the interest rate paid on overnight loans in the short-term money market, which is normally used by the banks. So in that way, you have an ES account, which is also known as an exchange settlement account. Basically, this is the account that is used to settle payments or clearing with the other banks and the RBA. Because the other banks may have accounts with each other where they transfer money to and from in accordance to whatever the rate is, as well as with the RBA. So this is not done through your normal account that you would have with your bank. It's done through specific accounts that are referred to as ES accounts, or ESAs, or exchange settlement accounts. So when an ESA or exchange settlement account is negative, the cash rate is charged as interest on the balance. So that's why I say cash rate and not interest rate, because the interest rate is different from the cash rate. The cash rate is not the rate that you would use when you go to the bank, you go to ANZ and you get credit, or you go to NAB and get credit. You go to Commonwealth Bank or whatever it is. Those are the interest rates for the banks. So the cash rate is not what you use, it is what the banks use, and then the banks will pass that on to the consumer via the interest rate. So the RBA can sell or buy Commonwealth Government Securities, CGS, Commonwealth Government Securities, it's a mouthful, to increase or decrease the supply of money that is actually sitting in the exchange settlement accounts. Okay, so the RBA, essentially what they're doing is they're trying to manipulate how much money is sitting in those ESAs, exchange settlement accounts. How do they do this? Through government bonds or securities, rather, to change around the supply of money that's actually sitting in there. It's very important that they do so because that helps the implementation of monetary policy by the RBA. So that's why I think a misconception that students often have is this idea that this idea that cash rate is the same as an interest rate, or they don't understand the difference between the two. But they do have a difference, and it's important to understand that difference in order to understand what the implementation of monetary policy actually is, and how the RBA actually goes in to achieve that. Okay, yeah, so if the RBA increases the cash rate, banks pay more to maintain their exchange settlement accounts. Okay, so it's very important to note that down in terms of this idea that the interest rate for the bank is not the same interest rate that we have, it's the cash rate, and then they can choose whether they pass that on or not. That's why sometimes you'll read articles where it says ANZ or NAB or Westpac have actually transferred or passed on the cash rate increase onto the interest rate. So this incurred extra cost, which is the interest, puts upward pressure on the interest rates. So essentially, it's like the RBA is saying, here's the new cash rate or the interest rate for the bank, and then the bank will say, okay, that's actually increased, so we're not just going to accept that cost, we're going to pass it on to consumers. How do they pass it on to consumers? They put it onto the interest rate for the consumers, and that's how they can push that up, and then that's how it impacts consumers. But again, it's important to note that cash rates changes are not always passed on by banks. Okay, so hence the impact can be limited, right? So sometimes the RBA will increase the rate or decrease the rate, but there will not actually be any impact onto the actual interest rate for consumers. So consumers don't face any impact or effect. And so that's limited by that nature of the implementation of monetary policy by the RBA. So RBA may end up not having much of an impact at all. So, for example, when would this be the case? Like, why would they not do that? Well, because sometimes cash rate cuts may not be passed on, because in the form of lower interest rates for consumers, so that the bank can make more profit. So they'll keep the same high rates or higher rate, and then they'll pay the lower cash rate so they can actually make more of a profit. Right, so hopefully that is making sense and is clear. Okay, so impact of changes in interest rates on the economic activity. So if the aggregate demand is growing too fast and consumer confidence is too high, the RBA may increase the rate because they want to try and control it. But they're increasing the cash rate. Again, it's the job of the banks, or the role of the banks, to see if they would like to pass it onto the interest rates, which they normally will because it's a cost for them rather than a benefit, which you see with lower rates. This is because an increased cash rate causes interest rates to increase, right? Because they're passing it on. And that raises the cost of borrowing for consumers. So that's actually going to decentivize or discourage spending in the economy. If AD is slowing down and consumer confidence is low, the RBA may decrease the cash rate. Okay, so that's another important thing to note. The idea of the opposites aligning, right? So they want to try and either increase or decrease according to what the situation is, and that will either incentivize or discourage spending. So this is because a lower cash rate causes interest rates to decrease normally, hopefully, if the banks pass it on, and that will incentivize spending, and it will actually encourage everybody, like consumers, to go out and to spend. So that is the impact of changes in the interest rate on the economic activity. So either encourage or discourage spending, depend on, of course, a range of factors, with either if the banks pass it on, how much savings that people have, etc. So that's important to note. Moving on to the transmission mechanism. So this refers to how much in the stance of monetary policy influence economic objectives such as inflation and economic growth, how changes in the stance of monetary policy influence economic objectives such as inflation and economic growth. So it's very important to understand the changes in the stance, so whether there's an increase or a decrease in the cash rate, the impact of that on the interest rate. So all of that will obviously have a major role and influence on inflation, on economic growth, and a range of other economic objectives which are very important. So this idea of intertemporal substitution channel of monetary policy refers to this phenomena that where interest rates are low and savings are discouraged, right? Think about it. So interest rates are low, savings are discouraged. They want people to go out and spend. That's causing consumption and other forms of investment to increase. They want people to invest, they want people to go out and spend, they want injections into the economy rather than leakages, which are like savings, right? They don't want people to save, they want people to go out and spend, they want to inject money into the economy. So until the rates rise again. Right, so until the rates rise again, think back to the GFC, think back to COVID, the initial, post-COVID response as well. So the wealth effect essentially refers to when lower interest rates makes borrowing cheaper Of course, we know that lower interest rates makes borrowing cheaper, which therefore encourages spending and increases demand for all different types of goods and services, rather than when it's higher interest rates making it more expensive, decreasing spending and decreasing demand. For example, in the housing market, making homeowners feel wealthier and more likely to spend. Right, so they feel like, hey, actually the interest rates are quite high. I'm doing quite well. Like, you know what I mean? Like, I'm happy to go out and spend a bit of money. The opposite also holds true when we're looking at the impacts of changes in the rates on the Australian economy or the economic activity in general. So this idea that the opposite also holds true for a higher interest rate, making consumers feel wealthier due to increased asset prices. Okay, so this idea that again, my sort of like you just as a homeowner just feel a lot wealthier because your assets are worth more than they were a couple of months ago because of the rate change. So according to the RBA, for every 1% decrease in their interest rates, household spending would increase between 0.1% and 0.2%. So there is a correlation there. And we can see why that's the case. It's very obvious because when we see a decrease in the rates, it means that people understand that it's now cheaper to borrow. So they're more likely to go and borrow. Right? So I hope that this is clear. Just please try to understand and really think about the transmission mechanism. Think about these concepts because they will come in very handy. And to understand them is really going to benefit you because they'll come in handy when you're writing essays and things like that to include those concepts into your response. So, moving on. So, the impacts of changes in the cash rate can be illustrated in the following diagram. So, when we want to tighten monetary policy, the RBA sells Commonwealth government securities, like we talked about. So they will sell the securities. What will happen is there will be a shortage of borrowable funds, right? Because there's not as much there to borrow anymore. So we know the simple rule that when there is a decrease in supply, the prices will increase, right? Because there's not as much available. Think back to the Yeezy example that I went through earlier. So then they will increase the cash rate, which again, not directly related to the interest rate yet, right? There's also a few steps in between. Banks may increase the interest rates if they wish to pass on the increased costs. They don't have to, but they can. They can choose to, but they don't have to. Again, making sure I'm like drilling the same concept. I know I sound like a broken record, but I really want you to understand this fully. Then debt servicing costs increase. Interest increases. Interest rates increase. That is the one that's going to impact consumers. So that's therefore we see a decrease in consumption when we see a decrease in investment spending. Right? Then we have decreased economic activity. So this idea that we do have that role that the change in interest rates plays on the economic activity. And it all started off by an increase in the cash rate. So you can see that flow. And this is a very difficult concept that, I really think is made a lot easier by a diagram like this because it's broken down. Otherwise, I remember reading this in the textbook and I was so confused because it was just like it felt really messy to me. So having it in a format like this really helps. So I hope that it helps you too. The opposite is the loosening of monetary policy, so it's literally flipped over. So the RBA buys Commonwealth government securities. There's excess of borrowable funds, so there's a lot of borrowable funds available, so they don't have as much value. So therefore they can decrease the cash rate. Again, the cash rate is not the same as the interest rate. The cash rate is there for the banks. So the banks may decide to decrease the interest rate to pass on the decreased costs. They will normally do this to become more competitive in the market, but otherwise they can also choose not to do it because they're benefiting, right? So debt servicing costs will decrease. Then there'll be an increase in consumption and investment in comparison to when there is a tightening of policy, because now it's cheaper, right? It's cheaper to borrow funds, so therefore an increase in consumption and investment can actually be helpful. And then, because there is an increase in consumption and investment, we know that this is an injection into the economy. And so the impact of this change in the rate on economic activity is that it will increase the economic activity because of the loosening of monetary policy. And it started off with RBA buying CGSs, securities. So you can see the difference between the two, hopefully, and I hope that the difference between the cash rate and the interest rate and the whole process is becoming a lot more easier to understand, especially where the transmission mechanism also comes in. You can see, like, the impact it has on economic objectives and economic activity. So yeah, would highly suggest to go through this. Just make sure you understand it, note it down, put it down somewhere. You also have these slides available to you as well, so just make sure you have it handy. I think it's really useful, a really useful summary of exactly what happens in the whole process. So yeah. So, impact of changes in the interest rates on the exchange rate. So, looked at it on the economic activity, on growth. Now, looking at it in terms of the lens of the impact it has on the exchange rate. So, high domestic interest rates increase the demand for the Australian dollar as savings rates are more attractive for investors. Right. So, high domestic interest rates increase the demand for the AUD. Why is this the case, right? Is because it's more attractive, right? You think about it, savings rates are, much more attractive because they're going to get a higher return. If I save my money when the interest rates are low, I'm not going to get that much back. If I save it when it's high, I'm going to get a lot more back. So as an investor, that's a great thing for me. This can cause an appreciation of the Australian dollar. So whereas low domestic interest rates may increase supply for the Australian dollar, as savings rates are less attractive for investors, and money may be invested internationally. Instead of, if I'm getting a very low return here, I may just decide to invest my money in another country that has a higher rate so I can get a higher return, is essentially what this is trying to say. Right? So this interest rate differential determines whether investment happens in Australia, whether investment increases, whether it decreases. So there are so many roles for monetary policy and for the rates. Like it's not just limited to just impacting economic growth. It has a lot of other impacts on the economy as well, which is important to consider. Right? So the interest rate differential determines whether investment and hence the demand for the Australian dollar increases or decreases. So, however, the impact on the exchange rate is a secondary function of monetary policy. It's not the primary function. And with the RBA focusing on stabilizing inflation as a priority. So their main role, and I think that's again broken record, the main goal of the RBA is to stabilize inflation, to keep it between 2 to 3%, and we've seen that with the recent rate hikes, the cash rate hikes. That we're currently sitting at about 7%. We want to get it down to 2 to 3%. That's their main goal. But in saying that, just because you're trying to achieve one thing doesn't mean it doesn't have a domino effect on other things, right? So it does still have an impact on the exchange rate, but that's not their primary function. So making sure you're able to distinguish between that and you understand that difference.